If you sell your personal residence, how much tax will you owe on the sale of that property? That is a really common question that we get from clients. My name is Merrill Taylor. I'm a CPA. I've been working with clients for a number of years, and we help them with special tax strategies to save a lot of money on taxes. We'd like to get into the sale of a personal residence and how that works. So first off, I'd like to clear a very common misconception about the sale of a property. A lot of clients will say, hey, I sold my personal residence. I want to apply my one-time lifetime exclusion to the sale of that property. That doesn't exist. I don't know. I've been doing taxes for 20 years, and that rule has not existed for 20 years. I think it might have been from the 90s, maybe. I'm not exactly sure, but it doesn't exist. There's no such thing as a one-time exclusion on the sale of property. A lot of times people will think if they sell their personal residence but roll the money into another property that they get some kind of benefits. That's not true either. That's kind of called a 1031 exchange, where you sell one property and roll it into another and not recognize gain, but it doesn't apply to the sale of a personal residence. What does apply to the sale of a personal residence is generally a much better what's called an exclusion. Exclusion means you just get to exclude the income and you never pay tax on it. So how does it work? Well, if you have owned a property and lived in it as your personal residence for 2 out of the last 5 years, then you can exclude up to $250,000 of gain if you're a single filer, or up to $500,000 of gain if you file jointly with your spouse. Now, when we talk about the $250,000 and the $500,000 exclusion, is what the exclusion means is you basically, let's say you're married, you sell the house, you recognize a $400,000 gain on the sale of that house, you're below the $500,000 exclusion, that $400,000 of gain disappears for taxes. You are never taxed on that. It doesn't roll over into a new property that you bought. It's not a one-time exclusion you get from your life. It's actually something you can take every 2 years on a tax return. And so you could technically buy a home, live in it for 2 years, sell it, and exclude the gain up to $500,000 if you're filing joint, then buy another home, live in it for 2 years, sell that, exclude that gain. Like you can keep doing that as many times as you want during your lifetime. There's no such thing as a one-time exclusion in that sort of way. And it's very powerful because it makes the income disappear. You are never taxed on that gain. Now, how do we figure out the gain that's on there? So this is often a very common question. So the way that you figure out the gain is that you take your purchase price. So let's say you bought the home for $500,000 and you bought it 3 years ago for $500,000. So you've owned it for over 2, you've lived in it for over 2 years. You bought it for $500,000 and now it's worth $1 million, or let's say now it's worth $1.2 million. So we know that we get the $500,000 exclusion, so we can take the $500,000 off that gain, right? So if you bought it for $500,000, it's now worth $1.2 million, and we can exclude $500,000 of gain. Well, now we have $200,000 of gain that we're going to be taxed on, unless our basis changed during that time. And the way that our basis changes is by improvements that we make to that property. So let's say in the 3 years that it was owned, maybe it was an older property that was bought, it needed new carpet, it needed a new roof, the kitchen needed to be redone, the bathrooms needed to be redone. There was a lot of work that you put into that. Let's say that you put $250,000 of work into that property. Well, that raises your basis. So you bought it originally for $500,000, you put $250,000 into it, now your basis is $750,000. So when you sell that property for $1.2 million, you're going to recognize a gain of $450,000, or you realize a gain of $450,000, but the gain exclusion of $500,000 would offset that. So you now are no longer taxable on the sale of that property. So you have to include everything in the sale of that. Also, when you sell the home, you're going to have closing costs that are come on that. You can deduct those closing costs against the sale price of that home. So let's say you sell it for $1.2 million, but the closing costs are, say, $100,000. Well, now your net sell price from that basically is $1.1 million. And then if you bought it for $500,000, then you got the $600,000 gain. Now you only have to put $100,000 into that home during the time you owned it to exclude all the gain from it and not pay any tax. So that's the way that works. So eligibility, we talked about that you have to have 2 of the last 5 years. You have to live in it as your main home. And then you can't have claimed that exclusion for the last 2 years on any other home. You can only do that every 2 years. And there are some exceptions. So let's say that you bought the home a year and a half ago. So you haven't met the 2-year exclusion test, but now suddenly you need to move for some reason. Let's say that you lost your job and now you got a new job in a new city and now you need to sell the home and move. Let's say you got married or you had a kid or multiple kids, or some life event happened that necessitated you selling that home and moving to a different home. The tax code luckily recognizes that kind of an issue and actually gives what's called like a prorated deduction for it. So let's say you owned the home for 1 year, then you lost your job and needed to move to a new city. Well, the tax code says, okay, yeah, you only owned it for a year, you didn't meet the 2-year requirement, but you are moving for a specific reason, some life event that has happened. So the tax code says, okay, well, you can now take your proportionate share of that. So if you lived in it for 1 year, so that would be half of the 2-year requirement, you can take half of the exclusion. So if you're married filing joint, you can take $250,000 of exclusion. If you're single, then you can take $125,000 of that exclusion. Whatever that ratio is. If you lived in it for 3/4 of the time, you could get 3/4 of the exclusion. Lived in it for 1/4, however that works. You just kind of calculate it on a day-by-day basis based on that. The home must be your primary residence. This doesn't apply to rental properties. You can't take the exclusion on those. The rental properties is where the 1031 exchange applies to. You can do a 1031 exchange on those to avoid recognizing gain on the sale of a rental property. If you do have any depreciation on that home, let's say that you own the home for 5 years, you lived in it for 3, and it was a rental property for 2 years. Well, you would have taken depreciation on that rental property during the time, or the tax code requires you to take depreciation. When you sell a home that's had depreciation taken, you have to recapture the depreciation as income. So you can't exclude depreciation through this exclusion. And then again, yeah, and if you did turn it into a rental property, you can still exclude it, but there are some exceptions that apply there. So that is how the sale of a personal residence works. It's a very powerful way of helping to save money on taxes. And for continued updates, make sure to subscribe to our channel and go to taxtutor.com to subscribe to our weekly newsletter.